Most investors think there are dozens or hundreds or thousands of different portfolio strategies, especially when you're looking at index investing. You've probably heard of things like the 60/40 portfolio or the all-weather portfolio or dividend portfolios or factor investing. It can feel like every expert has a completely different opinion on what you should do. But here's the reality. Almost every portfolio out there is built on just a handful of core ideas. So once you understand these ideas, everything starts to make sense. You stop chasing strategies and you start understanding why they exist. In this video, I'm going to break it down to the 6 core concepts that sit behind almost every well-known portfolio. And those are owning the market, balancing risk, tilting for higher returns, adding alternative assets, optimizing for behavior, and using leverage. And more importantly, I'm going to show you how real portfolios are built from these ideas and why different investors choose different approaches. Because at the end of the day, investing isn't about finding the perfect portfolio. It's about understanding the problem you're trying to solve and choosing a strategy you can stick with for decades. So to start this off, let's get into it. Owning the market. I would classify this as a lot of the core main strategies that you've most likely heard and read about. It's the passive indexing. A lot of these are all passive indexing, but there's a core strategy here. And what it basically is saying is that you cannot consistently beat the market after costs. So own it instead. So the S&P Dow Jones indices, SPIVA reports show that most actively managed managers underperform their benchmarks over time. The longer the time frames, the worse the results tend to be. This isn't just, bad luck or, having the wrong person in place. It's structural. Fees reduce returns, trading introduces mistakes, and market timing is extremely difficult. And so the key concept here is own the market. So buy broad-based index funds, keep costs extremely low, rebalance occasionally, and stay invested long-term. What are the trade-offs? You never get to beat the market. You have to accept all of the aspects that go along with this approach, such as all of the market downturns that happen as the whole picture starts to crumble and go down. When the economy is crashing, you're crashing there alongside it. But it requires discipline during those crashes. So what are some examples of this core strategy? And a lot of these strategies are built within a lot of retirement portfolios. Well, there's the Boglehead 3 fund portfolio or the 60/40 portfolio. And the Boglehead 3 fund portfolio simply is just having a percentage of stocks that are domestic, so such as like the S&P 500, having international stocks so that you have a globally diversified approach, and then having a portion of bonds. Where the 60/40 portfolio is simply just allocating the percentage of stocks to bonds. And it may be just those domestic stocks that are being held. So there's lots of different types of approaches that I would say just maybe splice that up a little bit more. For an example, Vanguard has a fund where when they look at the total stock market and the international stocks, they actually break down the bonds where they have domestic bonds and they have international bonds. And so it's still based on that same premise, but it's just something a little bit different. So there are various types of portfolios out there, but a lot of them come from that first key concept. Now, there's another concept out there in the world of investing called the risk parity. And so what we're doing here is, a lot of this comes from, Ray Dalio and actually Bridgewater Associates. So if you're wanting to find out a little bit more information on that, do some digging and some research around that. But the concept here is basically that most portfolios are not truly diversified. They are dominated by stock market risk. So even a balanced 60-40 portfolio, right? 90% of the risk comes from the stocks, not necessarily those bonds. So that risk parity, right, tries to fix that by what? Allocating based on risk contribution, not dollars. So how it works is it spreads your exposure across things like growth assets, deflation hedges, inflation hedges. What does that look like? It could, it looks like adding not just the stocks and the bonds, but we're looking at adding commodities and gold and things of that nature. And the goal is to perform reasonably well in all various environments. So whether you're going through a recession or growth or inflation or deflation or whatever the environment is, that your portfolio is safeguarded in whatever setting that is. But there's a trade-off to that. And the trade-off is lower expected returns than stock-heavy portfolios. They have a heavy reliance upon bonds. And they can underperform in strong bull markets. And so what are some examples of this? Well, we have the all-weather portfolio, which is by Ray Dalio. That's what a lot of people associate with this all-weather portfolio. And you're getting into having those stocks, getting some long-term bonds, some intermediate bonds, some gold and commodities. Or, there's another one out there called the permanent portfolio. And in that, you are simply invested in 4 different things. You've got stock, bonds, gold, and cash. And so the whole idea is that both of those portfolios are factoring in that key concept, which is that most portfolios are not truly diversified. They are dominated by stock market risk. So again, it boils down to a concept. So we've learned the first concept, right? Which is owning the market. And a lot of people look at owning the market as one approach. And then, there's another layering in there where, there's been research around having that risk parity and looking at that diversification. So that's another key concept. Another one is called tilting for higher returns or factor investing. And so this is the third concept. And so what is basically happening in this approach is certain types of stocks have historically delivered higher returns. And, things like, for example, if you start breaking down the various sizes of stocks, we can see that small cap stocks have had a higher return. We can see that, when you go after, profitability, investment behavior, all of these things, you start factoring in these different elements. So what you're doing is instead of buying the entire market equally, you're overweight certain types of stocks. For example, like the small cap, that really tends to be a large aspect in the factor investing, but you're still broadly diversified, right? But intentionally tilted. So it's taking on, again, those key concepts in that first point. But it's tilting it now. And so, why does it work? These factors may represent, right, our additional risks, or they present behavioral mispricing, and there are trade-offs to it. So, there's things like long periods of underperformance. There's probably more complexity that's involved with it, depending on which strategy you're picking. And it requires a strong discipline. So you have to have these convictions. You have to have a lot of understanding of these different types of breakdowns. So you've got things like, there's another YouTube out there by Ben Felix, and he's created a model. And so he's broken it down and even given ETFs around what his approach is. So he's got things like where he's owning the total Canadian stock market. I'm from Canada myself. So I understand that if you're from the States, you might, have to modify it, but there's a percentage of like that. There's a percentage of the US market, of US small caps, having international small caps, having emerging markets, that sort of thing. And then there's other approaches like the Paul Merriman, like ultimate buy and hold strategy. And so in that one, he's got like 10 various types of things where, everything's broken down into a percentage of what he owns. So he's got large cap, small cap, or sorry, it even breaks down things like small cap value stocks, REITs, all sorts of things that he puts into that portfolio structure in order to have those various tilts. So it's still within that passive indexing sort of approach, but it's basically saying that all parts of the market are equal. So that there's actually an advantage you could have by tilting in one direction. So that covers the third concept of where there are a number of portfolios that fall under there. So let's get into the fourth one. So the fourth one is endowment model. And so there's David Swanson at Yale, where he was looking at this and said, okay, stocks and bonds alone are not enough for optimal diversification. And so really what you're doing at this point is you're getting into a little bit more of like the institutional type of investing. So you're getting into things like private equities and real estate and hedge funds and commodities. And so with this approach, what you're doing is you reduce the reliance on things like the public market, and you're adding assets that behave differently. So they aim for uncorrelated returns. So in a way, you could kind of say it's kind of like the second point that we brought up, just about that risk parity, but it really kind of, I would say, categorize it a little bit on its own. Again, these are just what I've sort of broken it down to try to help give you a framework of understanding of where portfolios fall. And the reason why it works for them is, they have all of these various large capitals that they're capital based of like resources that they're able to deploy into all of these different type of sectors, and they've got a long time horizon, and they're able to do that. But there are some trade-offs. It's hard to replicate for individuals. So like for someone like myself, it can be very difficult. Usually there's higher fees that are associated with doing different types of investments depending on what they're invested in. And there's less transparency and liquidity. So there's a number of various types of risks that can come from just simply having those unconventional or just, harder to get diversifications. So having something like David Swanson's model, you're looking at things like having that total stock market, international stocks, emerging markets, treasuries, tips, REITs, all sorts of things. And then you've got things like, MEB, Faber, IV portfolio, where you can actually, I would say, breaks it down where you can actually have a lot of these various versions through like ETFs, where you can basically own, a version that can actually be, that's actually built more for like consumers like ourselves. But it really works best for institutions. But there are people that have tried to create various portfolios that you can mimic to try to sort of mimic some of the characteristics of that concept. So that is one category. Another one is the income-based investing. I'm not going to get too deep into this one, but the idea is, or behavioral. So investor behavior is one of the biggest determinants of long-term returns. And so basically the core concept here is that, with having all of those behavioral problems with panic selling and chasing performance and all of that, a plan that you can stick with consistently is the one that's going to win out in the end. And so then what a lot of people tend to do is they go for like dividend portfolio or income focused investing. And for a lot of people, it can be very predictable income, right? It's emotionally more comfortable. It reduces that temptation to sell because you're seeing those dividends coming in. But it may reduce the total returns. From what I've learned is it really does reduce those returns in a lot of ways. A lot of the various portfolios I've seen around, that dividend or that income approach. But again, to each his own, right? So maybe I'm just more biased because I have more of those disciplines that way, and I'm willing to kind of nerd out a little bit and diversify and do all of that self-management and, be more in control of my emotions that way. And then the last point I want to get out is point 6, which is basically leverage. And this is capital efficiencies. This has probably grown a lot more significantly over the years because of the various instruments that are now available to retail investors, where we weren't able to get into a lot of the futures and a lot of other types of investment tools like options trading and stuff like that. And the whole point here is, instead of taking more risk by concentrating in stocks, we're using leverage to diversify better. So think of it like, you have a portfolio that's working really well. Instead of saying, well, I'm going to find a different portfolio that has a different type of, risk structure. Instead, you could just simply say, okay, you know what? I'm going to take this portfolio and I'm just going to leverage it up a little bit. And again, when we're talking about a little bit here, or using leverage in approaches like this, we're not talking about 10, 20 times leverage. We're talking about maybe from having, 1 times leverage, and maybe upping that to like 1.2, right? So like 1 times meaning, the stock you're owning 100% stock. So 1 times of the investment, you might go to, 1.25, right? So you're just slightly elevating that risk, or maybe, 2 times, or maybe 3 times, if you want to get into extreme portfolios like hedge fundies, Excellent Adventure, something like that. There's a portfolio like that where they're using 3 times leverage, and they're taking something like simple, like where you're taking like that 60/40 portfolio and you're 3 times leveraging it. There's risk to that. And then there's other people that have studied in regards to that leverage, and they said, well, investing shouldn't just be considered, what kinds of risk you're taking on, like, factoring in that volatility, but you should be factoring in risk over time. And so, you might have a higher ability to take on that leverage early on, and then as time progresses, going later into life, that risk can change. So you can change that leverage to becoming unleveraged. But there's an argument here that actually leveraging up various portfolios, there are actually, like, if you look at the various ways to gauge risk, like looking at your Sharpe ratios and stuff, you can actually find that there are portfolios that actually have shown that, they could do a little bit better with that leveraged approach. And so there's an argument to be had in some portfolios being in this camp. So, diversified portfolios are safer. So, leveraging on this can be beneficial, because you don't have to change your investment approach, like, taking that 60/40 portfolio and adding a little bit of leverage, versus getting into something where, you're getting into the, you're getting into like David Swanson's type of portfolios, and the endowment fund and all of that kind of stuff. Like you're really, you're saying you're deciding what your trade-off is going to be. But there are trade-offs to it. And one of them is that you can amplify your losses. So a lot of people think, you're going to have this crazy advantage. Well, there's actually ample losses. It requires a strict risk management profile. It's easy to slide that leverage, over into being higher leverage when times are good. And then when times are bad, right, you want to lower that. So there's that behavioral difficulty as well. So if you're having a hard time in the behavior department, when it comes to investing, this is probably going to be one that you want to stay away from. And so the whole point here is that you now have enough depth to confidently say every portfolio strategy is solving a different problem, right? So passive index solves cost and consistency. Risk parity solves economic uncertainty. Factor investing solves return optimization. Endowment models solves diversification limits. Behavioral strategies, right, solve investor mistake. Leverage solves capital efficiencies. So there's a lot of different reasons why people would pick the various portfolios underneath those various types of approaches. And so that's really a great way to kind of break it down so you can understand it. And then the other dynamic too, just to add to this, is that, you know, every portfolio you see online is just a combination usually of a few of these ideas, right? So for example, like the Ben Felix portfolio is that factor investing, and it's very passive. So it's 0.1 and 0.2, or was it 0.3? No, it was 0.3. So 0.1 and 0.3. You know, the IV portfolio, right, is that endowment, but it's also passive, right? You know, getting into that leverage, right? We've got things where, anyways, you get the point. So the final point here is just, you know, you don't need to memorize all the various portfolios out there. Really, I would just say understand these key concepts. And then if you understand what's behind them, you can actually find out which path you want to start going down and find something that actually fits your goals, your risk tolerance, your ability to stay invested. And that's really the key there. So I hope this video was beneficial to you. I hope you got a little bit more understanding of the markets, the various ways that they're broken down when you start getting into that, you know, like ETF type investing, passive investing, and be able to understand, you know, which portfolios you might consider and how you want to break those down. So I look forward to see you guys in the next video. Take care.